Warren Buffett, the Oracle of Omaha, arguably the greatest investor of all time, recently announced that he was selling some of his shares in Apple stock. That's creating a panic among Apple stock investors, asking if they too should sell Apple stock. I'll address that question in this video, looking at it from several different perspectives. So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so despite the sales, Apple remains Berkshire Hathaway's biggest holding, representing about 40% of its portfolio, which had a total value of $335 billion at the end of the quarter. At the end of 2023, the portfolio was valued at $353 billion, with Apple representing about 49% of the portfolio's value. So what's happening here is Apple's value from the end of 2023 to the end of the first quarter of 2024 decreased inside the Berkshire Hathaway portfolio from roughly 50% to roughly 40%, still consisting a large portion of the overall portfolio. I've been highlighting that having half of your portfolio in just one stock is a very big risk. You're concentrating your portfolio in just one stock. Finance theory suggests that you should diversify your portfolio among 20 to 40 stocks. That way you get the benefits of reduced risk while maintaining the return expectations. I've said Warren Buffett does it, but that doesn't mean the rest of us should do it. Warren Buffett, like I highlighted, is one of the best investors of all time. It's one of those situations where it's like, don't try this at home, right? I'm doing it because I'm a master. I'm referring to Warren Buffett. He's doing it because he's a master at the craft. That doesn't mean we should all be doing what he's doing, because 50% in one stock, too much risk in my opinion. So I also highlight that investors like Warren Buffett, they have many reasons for why they're investing in a stock. It's not always because they feel that the stock is undervalued. There are other reasons, strategic reasons, for which one of which could be that when you own such a large percentage of one company, and when you have billions, hundreds of billions to invest, you can influence that company. You can have influence over that company. You can suggest someone to the board of directors. You might want to have someone on the board of directors or two people. And you can do that if you own a significant portion of one investment. And therefore, concentrating your investment in one company gives you a lot of power for your money. And that could be one reason why investors like Warren Buffett hold these types of positions. Now, I'm not saying that's why Warren Buffett is doing it in this case, but it's just one reason, one example of investors choosing to invest in a company, not just because they think it's undervalued. And I think a lot of retail investors get the misconception that when someone like Warren Buffett or Cathiewood or Bill Ackman or Ray Dalio or any of these well-known investors, when they buy a stock, it's because they think it's undervalued. And that's far from the truth. That's rarely the only reason why these investors invest in a stock. There's other strategic implications, and that's why I suggest investors should not follow these other investors into a stock. Just because Warren Buffett bought it doesn't mean you should buy it. Just because Warren Buffett sold it doesn't mean you should sell it. You should look at these companies on your own, do your own due diligence, and come to a conclusion if you think the stock is a buy or a sell, not withstanding what Warren Buffett is doing. So let's take a look at Apple, right? Let's evaluate for ourselves. And undoubtedly, Apple stock has come into some challenges. Revenue is declining. Revenue in the latest quarter fell to $90.7 billion, down from $94.8 billion in the same quarter the prior year. Apple's iPhone difficulties have been highlighted, especially in China, where competition is rising to take market share. Net income is also falling, $23.6 billion in the latest quarter, down from $24.1 billion in the same quarter the prior year. So challenges exist for Apple. It hasn't innovated significantly in several years, and the Apple Vision Pro, which is its latest innovative product, is selling at roughly over $3,000. And so that's not going to reach broad market adoption anytime soon. So you can understand investors being concerned with Apple stock. Now, the greatest risk for Apple stock come from the geopolitical tensions with China and its competition in China, losing market share in that region. And you can see in the latest quarter, the company's sales in the Greater China region fell to 16.3 billion, down from 17.8 billion. In the first 6 months of the year, sales in the region fell to 37.19 billion from 41.7 billion. So that's the greatest area of risk for Apple. The segment in Greater China, it's falling, but thankfully it's roughly 20% of Apple's business, only 16 billion out of the 90 billion in total net sales. So roughly 20%, less than 20% of its business. That business will remain under pressure going forward. The iPhone is the next category under pressure, with sales falling to 45.9 billion, down from 51 billion in the same quarter the prior year. And this is the entry into the Apple ecosystem. If you're not buying an iPhone, you're probably not buying AirPods, and you're probably not buying an Apple Watch. Maybe not, you're subscribing to Apple Music or Apple TV Plus. So if you own an iPhone, it makes purchases of all of those other products more likely. If iPhone sales are falling, it's likely going to hurt sales of all of the other segments in Apple's business. Apple hasn't innovated in the iPhone for some time. Every year, it just makes things incrementally better, changing the design ever so slightly, increasing the battery size, changing and improving the camera. Minor improvements every year, but minor improvements, nothing innovative. While its competitors have been making progress leaps and bounds, catching and even surpassing Apple in some cases in terms of the performance of the phones. Apple's been able to retain strong sales still because of the strong ecosystem it's built, because of the higher cost of switching. If you've been in the Apple ecosystem for, let's say, 5-6 years, it's hard for you to switch to a competitor because you've got so much of your digital life on Apple devices. And so it's difficult to switch. Apple counts on that higher cost of switching to keep you in the ecosystem without needing to add significant improvement to the iPhone. However, given these declines, it's more urgent now for Apple to deliver innovative improvements in the iPhone. Now, Apple stock price is down 4% on the year. Of course, the stock price jumping following the company's latest quarterly earnings release, where it told investors it was going to buy back over $100 billion in its shares. Still, Apple's stock price is not expensive and it's not cheap. It's trading at a forward price to earnings of 25.6. It's been cheaper, it's been more expensive, it's roughly fairly valued. So to answer the question I posed in the headline, Warren Buffett is selling Apple stock. Should we all sell Apple stock? And for me, I own Apple stock and I'm not selling Apple stock because Warren Buffett is selling Apple stock. I wouldn't advise anyone else to sell Apple stock because Warren Buffett is selling it. If you feel you have reasons to sell, then that's your own personal decision. You shouldn't follow Warren Buffett in selling Apple stock. I know I'm not. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.